a buyer has come along interested in the business, and there are two ways really of taking that forward. The buyer can either buy the business itself off the company. It's tax-wise is a fairly simple approach to take. The company is just selling all of its assets. The employees will move across under 2P. For VAT, it will be fairly neutral, probably have a transfer of a going concern, and the buyer will get a completely fresh start. But there are issues on the non-tax side that can be quite complex. They're going to be all of the contracts, the suppliers, licensing agreements, and everything may need to move across, the customers as well. And setting up and transferring the business across will often give freedom to the buyer or also to the customers, and those are the contracts, to maybe try and renegotiate if they feel they're not in a good position. Also, there can be a lot of contracts that are needing to be dealt with. Also, there'll be tax charges triggered. The company is selling all of its assets, and it will be taxed on those. The buyer may have tax charges, in particular if there's real estate involved in the UK and other jurisdictions, that can actually trigger a tax charge in itself that can be quite high. And then also there's potentially double tax arising for Rachel and Stein, because the company will get taxed on its disposal, and then when they try and take the money out of the company, they'll be taxed as well. So the alternative is just to sell the whole company, and that will do. For a group, it's certainly more normal to do that, because otherwise you have to renegotiate loads of separate businesses moved across, whereas at least for the group, you just sell the parent company. But here, actually, the Dutch company is held independently, so the UK company could be sold on its own. Conceptually, it's easier than a business sale, because there's just one sale of the shares, but there's no need to move contracts. So again, that helps, but it may still be necessary, because sometimes contracts will have provisions in that will look for change of control setups. But it can be also now, here the disadvantages of selling the company is that it's a significant, more complex process for the buyer and the seller to fulfill, because the buyer's going to need to carry out due diligence. Because not only is the buyer buying the current business, they're buying the history of that company. And so what they'll want is they'll want a level of indemnities and warranties in respect to the previous and the historic operation of the company, to make sure that they are protected if there is something in the past that comes up and bites the company later at a cost to the company.
An earn-out mechanism always sounds to me like a win-win for both sellers and buyers, especially here where RSK has a short track record but significant growth potential. Under this model, an additional sum will be paid if RSK achieves certain financial goals, which are usually stated by reference to EBIT or EBITDA, and generated across a number of financial periods after completion, often with a cap. The period can be short, 2 or 3 years, or lengthy. The longest one I've seen is 8 years, but a colleague of mine told me he had put together a 10-year earn-out. EBG may feel that an earn-out will incentivize Rachel and Stein to stay with the business and assure integration, and it may be attractive to EBG to pay a chunk of the price out of the future earnings of the RSK business as a hedge against overpayment. For Rachel and Stein, an earn-out can help achieve a higher price, albeit payable over time. However, they will be nervous that the business could be manipulated against them by EBG, so they will doubtless seek to insert seller's protection into the contract, e.g. to prevent income being taken into another EBG associate, or group costs being loaded into RSK, or key accounts being shifted away from RSK. And it is these sellers' protections that may have the unintended consequence of hampering EBG's integration of the RSK business, resulting in a loss of economies of scale. And the sellers will never capture every eventuality in their sellers' precautions. For instance, EBG taking on a competing product which cannibalizes RSK sales, or a pandemic. Sound familiar? My firm often finds that an earnout makes it into the term sheet, but is later dropped as part of the detailed negotiations.